Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 315 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about ignorance, right? And specifically financial ignorance. And now this is a word that a lot of people look at in a very negative way, right? To be ignorant, it's like, it's like something dirty that you would say to somebody, something mean that you would say to someone, right? But the meaning of ignorance is not necessarily mean, right? Now, it can be used in derogatory ways, but it's not necessarily mean, right? So I want to talk about financially ignorant people, and this is probably far more people than we care to mention, but I want to talk about people who are financially ignorant and some of the top ways in which they are financially ignorant and some of the things that I hear that are just ignorant statements, right? Statements of not knowing, statements of lack of education, and we'll discuss all those and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual watching or listening to this show on a day-to-day basis. Now, to be ignorant about something is literally just to not know, right? It's to not have the education, to not have the knowledge, right? To not be aware of, right? And I would say, I would offer up that with finances, many of us are ignorant in a lot of areas. Because it's not because we're not smart people, right? You can be ignorant about something and still be a smart person, right? I'm not suggesting we aren't smart people, right? So we can be ignorant about something and still be smart people. So it's not that we're not smart, right? And it's not that we don't care. You can care and still be ignorant, right? But it's just that we don't know. And sometimes we don't know where to look. Sometimes we don't know who to ask because there's a lot of bad information out there, right? There's a lot of people out there who are going to give you opposite advice than what I would give you about your personal finances. And that's all fine and good, whatever, right? It's not great to follow, but everybody's entitled to their own opinion, even if they are wrong, right? But I want you to have the knowledge, the truth, the understanding of what is going on in your financial life and what should go on in your financial life to be most efficient to get you to long-term financial freedom, right? And so there are some things that I see time and time again that pop up in the way people talk about money and the way people think about money, right? And they are just some common ignorances, right? And these common ignorances, they're not groundbreaking necessarily, but they are things that I hear people say, and they are things that I see people do, right? Sometimes people won't say things, right? But if you follow their actions, you'll be like, oh, well, this is what you really think about money, or this is what you really think about whatever it is in life, right? They can say whatever they want, but if their actions do not follow, then it's very difficult to pin them as the thing that they said that they are, or the action that they say that they're going to do. Okay, and I think in finances, it is the exact same way. And I mean, who can blame us for being financially ignorant, right? Nobody taught us. Right? It was taboo to talk about finances with adults when you were a kid, right? It's to this day taboo to talk about personal finances in a real, close-knit way with somebody unless you just know them very intimately. And even those people, sometimes it's just uncomfortable to talk about finances with them. And then you go to school and, the schools aren't teaching you about how to manage your money properly in most cases, right? So I think there's just a big failure when it comes to education. That's why I'm here every day. That's why I have this show. That's why I'm trying to just constantly educate you, bring you the knowledge that you need about your personal finances so you can move forward into financial success. You can move forward into a place where you can win financially over the long term, okay? But I want to address some of these ignorances. That way, now we can have the knowledge, now we can know, and then once you know, there's no excuse. Once you know, then it's no longer acting in ignorance, it's acting in, just defiance of the truth or in denial or whatever, right? But at least you'll know what is actually true at the end of the day, okay? So the first thing and that I think is just out of ignorance, we think this, is that savings is just money that's to be kept in a savings account. Okay, when you were a kid, I know I did, and I've heard a lot of people that it was like this as well, right? You would have, your parents set you up a savings account. And that was a big deal. That's where you could put money away. And, not that I really put money away too much in that savings account, or it wasn't a big deal in my household, right? But you hear of a lot of parents like creating a savings account for your kid. Teach your kid what a savings account is. And I think that's a little overblown because when it comes to your long-term financial life, understanding what a savings account is really of very little consequence. Okay? Now, should we have savings accounts? I think that is a necessary thing in most cases, right? I tell you guys what we should use savings accounts for. And so if you don't know, we'll just recap, right? When we save money, right? Because we know our three uses of money. Our three uses of money are spending, saving, and then giving, okay? Now, when we save money, that money is literally money that's being set aside, right? So if you look up the definition of save, right, from a financial sense, it means to keep and store up for future use. Okay, it doesn't say where. It doesn't say, what account it's in. It just says to keep and store up for future use. And so when we are saving, it doesn't necessarily mean that it's in a savings account, right? In a lot of cases, the money that we're saving is money that's going to be invested. But we'll get to that in just a second. So what would we use a savings account for? We would use a savings account for our emergency fund, right? Because that's money that we don't care if it grows or not. It's insurance against tragedy. Okay, so we put that money in a high yield savings account or even a money market account, but we're talking about savings accounts here, right? We might put that money in a savings account because we could need it at any time. Okay, so we would put our emergency fund there. We could also put money that we're going to need in the next 3 to 5 years into a savings account because maybe we'll need it to buy a car. Maybe we'll need it to help send our kids to college. Maybe we'll need it to do any number of things that we'll need to purchase in the next 3 to 5 years that are significant things. And, maybe you're saving up a down payment for your first house. That's something that you need to be putting into a savings account if it's in the next 3 to 5 years of your goals. Okay. So that's what we would really use a savings account for. Okay. So in that sense, yes, savings is money in a savings account. Okay. But savings accounts are not the only place that you can save your money. And they are far and away not the only place that you should be saving your money, right? You should be saving your money into accounts that are tax advantaged, right? So when I talk about different types of retirement accounts like Roth IRAs, traditional IRAs, when I talk about health savings accounts, when I talk about your 401ks, your 403bs, all these different types of tax advantaged accounts, right? Those are places where you can save money, right? Because again, it is keeping and storing it up for the future. It doesn't necessarily mean that money just sits there like it may in a savings account, right? Yes, savings accounts are going to pay you a tiny bit of interest. And right now, yes, it is a tiny bit of interest, far lower than it has been in the past, okay? But when it comes to your investing, right, you plan on that money to grow. And I tell you all the time, if it's 3 to 5 years or more that you can put that money away for, by all means, invest it. Okay, and I give you the 3 to 5 years as just kind of a buffer, right? If it's something you're going to need in 4 years, I'm not mad at you for investing it, but ultimately, it's kind of on that edge of what I would consider investable, because ultimately, and this is just some information that I saw recently, if you look at rolling monthly returns from 1926 to 2021, right? And let's say you looked at how often is the stock market positive, okay? How often does it grow? Well, if you held money in the market for a month, it's positive 63.1% of the time. Okay, so obviously putting it in for a month, that's kind of it's a gamble, right? Because there's 37% of the time that it could be negative. A year, 75.7% of the time. Okay, so there's still 25% there where it could still be negative. 3 years, the stock market is positive 84.2% of the time. So there we're looking at 15.8% of the time the stock market is negative. And then 5 years, the stock market is positive 88.1% of the time. So that's 11.9, 12% of the time the stock market is negative. I'm far more willing to roll the dice with 12 to 15% chance that the market is negative than I am 25% chance or 37% chance that the market's negative, okay? So if I can put money away for 3 to 5 years or more, right, I may invest that money. But if it's anything shorter than that, let's put it into a savings account or a money market account or something, because we need that money to be there. And the fluctuations in the short term of the stock market are not going to allow us to grow our money in a reliable way. That's what we're about, right? When you want to grow your money, you want to grow it in a reliable way. And just thinking that, hey, I'm going to put money into this, brokerage account instead of a savings account for a year because I'm going to need this money in a year, that is going to have a 25% chance of being a negative move. You have a 25% chance of actually losing money on that deal, right? So understand where saving sits and where investing sits, but they both typically fall under this heading of we're going to save money, but it doesn't mean that you have to save money just in a savings account. So savings accounts, not necessarily synonymous, okay? You can save money in many different places. Now, what's the second ignorant thing that I hear? The second ignorance that I hear is that having a retirement plan in your 20s or in even your early 30s, that's too early, right? We don't need to save for retirement yet. That's ignorance, okay? Because people are thinking, I'm talking about putting money away for retirement. I'm nowhere close to retirement. Why should I even think about it? Why should I even worry about retirement when, I'm 26 years old or I'm 32 years old or I'm 22 years old, right? Why should I think about retirement? Well, it's just ignorant. It's not understanding one of the key tenets of finance, which is compound interest, right? Compounding your money for the future. And you may be saying, well, Dylan, I have a Robinhood account and I put money into this Robinhood account, this taxable brokerage or whatever. That's okay, right? That's not the worst thing. But I want what's best for your financial life. And these retirement plans or retirement accounts, they have some distinct advantages that you do not have in a taxable brokerage account, right? You have these tax advantages to where either you get a tax break today and then that money grows in a tax deferred manner, or you get, to where you put in after tax money today, but that money grows tax free and you can take the money out tax free later. Right? And this is, of course, saving for retirement because the time when you can actually take that money out and use it is the retirement age, right? 59 and a half for IRAs, 401ks, 403bs, age 55, and things of the like. But if you're investing in these things early, you can allow your money to grow in a tax-free or a tax-deferred way. Whereas if you're putting it into a taxable brokerage account or maybe even actively trading within a taxable brokerage account, maybe you're making money, but you're constantly paying taxes on the gains that you realize, that can be an issue, right? So having a retirement plan as early as possible is very beneficial. Now, should all of your money go into a retirement account or a retirement plan? No, by all means, no, right? That's not what I'm suggesting. Because just because, you can only take money out of a 401k once you hit 55 or an IRA once you hit 59 and a half, doesn't mean that, you want to wait until then to retire or to live off of some of that money. Right? So maybe, yes, you're putting money away in buckets like that where you do have those age restrictions, but you may also be putting money into taxable brokerage accounts, but doing so in an efficient way, right? Because if you put money into a retirement account, right, that money can grow tax deferred or tax free, right? And any trades that you make, there's not going to be any taxes on the gains as you go. Right? So that can be valuable to you if you're trying to invest in individual stocks or something like that. But if you're putting money into a taxable brokerage to grow for the long term, you're going to want something lower turnover, lower cost. That way you're not realizing a bunch of gains as you go, and you're able to keep your costs down and just allow your money to grow as tax efficiently as possible. Okay? So having a retirement plan early is super useful, and it will allow you to grow your money, and you absolutely should take advantage of retirement plans as early as you can, especially if you work for an employer that's offering you some free money. That's why that's a specific part of the financial action plan, is to take advantage of your employer match, because it is free money that you should be taking advantage of, and that's money that you can never get back. Right? But it's money that you would not have if you didn't choose to invest. And the earlier you get that money, the more valuable that money is going to be over time. So start early, put money into tax advantage retirement accounts, and if you are trying to do some bridge investing, which is that, taxable investing, if you want to retire earlier, then you can do that as well. But that should not be the only way that you go about investing your money, okay? Now, the third ignorance that I hear, and this is just super common, right? This is a super common statement, and it's frustrating. And I think even if somebody doesn't say this, I think far too many people actually believe it, right? And that is that you need a lot of money to invest, or you need a lot of money to become wealthy. That's not true, right? You don't need a huge income to become wealthy. You absolutely don't, right? I think, and this is me talking, right? But I think that if the vast majority of Americans, right, could just, look at their budgets, actually have a budget first off, right? And then look at their budgets and track their spending and trim down the unnecessary crap, right? And just focus on things that are necessities for a little while and find the margin in their budget. Because I think most Americans have margin in their budget, but they refuse to find it. Right? They're like, okay, I'm just spending money all willy-nilly throughout the month, and then it looks like I don't have anything left, and I live paycheck to paycheck. But I think a lot of Americans actually do have money that they could invest, but they just forego it and consume it, right? They don't want to invest that money, or maybe they do want to, but they're too consumer-driven, and they don't track their expenses, and they don't budget, and so they don't know where the money's going, right? But I think if most Americans did that, if most Americans did track their spending, did budget, all those good things, right, then they could find hundreds of dollars a month at minimum to invest for their future, right? So let's just say we have a 30-year-old, right? We have a 30-year-old who wants to be a millionaire, right? Pretty good show back in the day, but nonetheless, who wants to be a millionaire, right? And let's say that they can expect to make an 8% rate of return on their money over the next, we'll say 30 years, right? You're 30 years old. I'm going to get you to age 60. Okay. And so that's going to be over 30 years. Let's say you start with nothing. You have nothing invested for your future. Zero. Okay. And you want to get to $1 million by the time you hit age 60 in your Roth IRA. Okay. That means that each month, right? Just stick with me here. Each month, you're going to have to put away $670.98 into your Roth IRA to get to $1 million. Okay, that's at an 8% rate of return. Let's say we made a 10% rate of return, which is very possible, right? That's $442.38 that you would have to put away every month to get to $1 million, right? Does this sound like rich people? No. Now, is this a significant amount of money to come out of your budget? Sure, but how much money are you spending on crap every month? How much money are you spending on stuff that you're not aware that you're even spending that much money on it? I would posit that you're spending a lot more money than you actually think you are, especially if you're not budgeting and not tracking your expenses, right? So let's just say this $442.38 a month, right? So over the course of a 30-year period, that means you invested $159,257.65, right? Per year, you were investing $5,308.59. That is not a whole lot of money per year, okay? And we can absolutely do that. And that's somebody who started at 30, right? Think about if you start at 25, right? You add 5 years to the calculation at 8%, right? At 8% and 35 years to invest, that's $435.94 a month. But if you make it 10% rate of return, that's $263.39 a month. You're telling me that you can't come up with $264. Or you're telling me that between you and your employer who may be offering you a match in your retirement plan, that you can't come up with $200, $300, $400. Right? I don't believe it. I don't, in the vast majority of cases, I don't believe it, right? And this can get you to being a millionaire, right? A millionaire doesn't mean that we're making $1 million a year in income. A millionaire means that if you take all our assets minus all of our liabilities, then it's $1 million, meaning everything we own minus everything we owe, right? And so that would get you to the millionaire mark. Look, all I'm saying is you don't need to be rich to invest, right? Something that I tell you to do and something that I have shown you on this show before, but let's just say you make an average salary of $60,000 a year. And let's say you never grew that salary. You just made $60,000 a year your whole career, which is not realistic. But let's just say that were the case, okay? I tell you to invest 15% of your income. Well, if you're out of debt and you have an emergency fund, you should be able to invest 15% of your income once you've done those parts of the financial action plan, right? Follow that very strictly, and then you should get there. Now, let's say that you are, again, 30 years old, right? 30 years old, you're going to invest till you are age 60. I want you to invest 15% of that $60,000, right? Every single month. Now, 15% of 60,000 divided by 12, right? Because that 60,000 is an annual number. And again, we're starting with nothing, okay? If you did that over a 30-year period, right? That would leave you with $1.695 million after 30 years, okay? And that is with you investing, ultimately it's $9,000 a year, right? So that's $750 a month. And that's saying you just put in $750 a month, not what your employer may do or what may come in as an employer match in that way, right? But that's $750 a month. Yes, that's a lot of money, right? But if you are thinking, hey, I want to build wealth and I want to do something for my future, there are sacrifices you must make, right? But you don't have to be wealthy to make those sacrifices, okay? You don't have to already have a lot of money in order to invest your money. Investing is easy and low cost for just about everybody. There's low cost index funds. There's low cost ETFs. You can open an investment account online in a matter of minutes, right? This is something that's extremely available to everyone nowadays, and it is available to you. You should take advantage of it, okay? So the ignorance that says, I can't invest. I don't have a lot of money. That's just a lie, right? It's something that if you don't understand, you may say that. If you don't know, you may say that. But once you know what I just said, then you can get on the right track. Now, the next ignorance is that risk is risky. It's only savings, okay? So investments are risky, right? And you can lose your money, okay? But we have to be very calculated in the risk taking that we do, okay? People are so afraid of investments. They're so afraid of the stock market, especially. Oh my gosh, the stock market is a cuss word to a lot of people, right? Because they know that there's risk and volatility inherent to the stock market, right? Yes, risk is risky, right? It is money that you've put away, okay? It's money that you have stored up, right? But just because something is risky or volatile doesn't mean that it has a huge chance of going to zero. Just think about if you're buying an index fund every single month, right? You're buying an S&P 500 index or a total market index every single month, and you're just buying it and buying it and buying it. Guess what? When March of 2020 hit, you would have lost over a third of your money or a third of the value of your money in those accounts. 100% you would have. But guess what? You hold it till today, you are far and away higher in the value of the money that you had in that account than you were back then, right? Far and away. And not even at the bottom, but before it fell, right? When it was at its top before it fell, you're far and away higher than that now, okay? We have to understand that the market is going to swing. There is risk associated, right? No doubt, right? Could you potentially lose all your money? Sure. But then the capitalist world and the way that we know it would no longer exist, okay? And we also have to understand that this money that we put away is extra money, okay? It's money that we are trying to grow for our future. Right? It's money that we are willing to risk in some way, shape, or form. We have this idea that this is a historically good way to invest your money, and we're going to risk our money in this way, right? Should you expect to lose it all? Absolutely not, because guess what? Nobody ever has, right? Nobody has ever invested in a broad market index and lost everything. Have people invested in individual stocks and lost everything? Absolutely, right? But have individuals invested in broad market indexes and lost everything? No. Have individuals invested in hedge funds or in group investments and lost everything? Sure, but these aren't indexes. These aren't things that are already prepackaged in a way that the only way you're going to lose everything is if all those companies lose everything. And the likelihood of that happening is it's basically zero. Right? And not only are they not going to lose everything, the likelihood of them not growing into the future is also almost zero, right? So we need to understand that, yes, we're taking risk, but risk is a part of the game, and we have to just sit through it, right? You have to sit through risk in your financial life. You have to sit through volatility in the market in your financial life. And guess what? It's going to be okay. It's going to hurt, right? The first few times that I saw 10% of my money go down, I'm like, oh no. And that's when you have really small amounts of money invested. But gosh, 10%, oh, that hurts. Or watching your money cascade downward in value 30+% last year. Oh, it hurts, right? But if you can have the wherewithal to understand the market, understand how risk works, and understand that, hey, if the market drops, then I'm a net buyer, not a net seller, you will be far better off over the long term. So understand that there's risk. Understand that the winners are the ones who hold on over the long term and not sell out when the risk rears its ugly head, okay? Then, the last piece of financial ignorance that I want to give you guys is that you don't need emergency liquidity. You don't need an emergency fund. You don't need savings right there, right? You could invest all the money that you have, right? Or you can, spend the money that you have, right? I'll just put it on a credit card if something big comes up. That is financial ignorance. That is not understanding how life works, okay? Because let's just talk about this for a second. I've talked to you many times about do not invest your emergency fund. Do not invest funds that you could have sitting aside for an emergency. Now, I tell you only have 4 to 6 months of household expenses in an emergency fund because we don't want to overdo it, right? We want our money growing for us, right? But we don't want to overdo it with the amount of money that we put in an emergency fund, right? So we put that much in an emergency fund. Everything else can grow, right? But if we were to invest that money, right, it could go down at just the wrong time. Think about the people who may have had I'm sure there's somebody out there, right? And I'd love to talk to them, but I'm sure there's somebody out there who had their emergency fund invested and coronavirus hit and the stock market dropped 30% and they lost their job. And so now they only have 70% of the money that they did have in their emergency fund and they don't have a job, right? So they need that money now, but they've lost 30% of it already, right? So it's like this double whammy that could have occurred, right? We don't want that to occur. We want that money to be, again, insurance against tragedy. So we want it to be there whenever we need it, right? And we want it to be there in full whenever we need it. Now, believe you me, every other dollar that you're not going to need within 3 to 5 years should be invested and leave it alone, right? I totally believe in that. Okay, but do not invest your emergency fund. Now, people who say, and I bet there's far more people who say this than say that first part where they're like, okay, we're going to invest our emergency fund. I bet there are far more people who say, I don't have emergency savings, so I'm not even going to try. I'm just going to say, okay, I have this credit card that has this limit, right? And I'm going to lean on this credit card if something emergency were to happen. This is a horrendous idea. This is a horrible, horrible, horrible idea. Why? Because if something did happen, you still don't have the money, right? You just have the debt, right? You're telling me that whenever something bad happens to you, you are just defaulting to going into debt for that thing, right? That is not understanding the system. That's not understanding that if something big happens, right, you lose a job or, you have a big medical bill or something, right? And you put it on that credit card and you can't pay that credit card off in the next couple months or whatever, you're going to start accruing a lot of interest on that credit card at very high rates because that's some of the highest rate debt that we can have, which is just foolishness, right? It's foolish to do that, right? You do need an emergency fund. You do need liquidity. You need money that you can get your hands on at any given time, okay? And it can fluctuate between 4 to 6 months of household expenses. I'm okay with that, right? But the more variable your income is, the more I may say 6 months. And the less variable it is, the more I may say 4 months, right? But we need to have substantial emergency savings in case something goes wrong, because ultimately something will go wrong, something will be costly. And then maybe you'll just be able to cash flow it from your income, which would be fantastic, and you don't have to touch your emergency fund. But maybe you'll have to touch your emergency fund. And guess what? When you have an emergency fund, it's like, shucks, that really stinks, but I have the money to pay for it, so just go ahead and pay for it. But if you don't have an emergency fund, it's panic. It's, oh my gosh, how am I going to pay for this? What am I going to do? What am I going to do? Right? That's not what we want. We want to have some calm and some, poise when bad things happen, because we want to be able to make the decisions in those moments that we need to make. We don't want to worry about money when somebody in our family is hurt. Right? We don't want to worry about money when, our wife or our husband and, or somebody has lost their job, right? We don't want to be worrying just about how are we going to keep the lights on. We want to worry about how can we help you get another job, or how can we get you healed however you need to be healed as quickly as possible, right? And that's what you need to worry about in those moments, and an emergency fund helps you to do it. Look, I am not chastising you for being ignorant in any of these ways. I hope that some of you came to watch this episode and had some of these ignorant thoughts in your mind. I hope that's the case, okay? But now you have the knowledge. Now you know how these things should work. And now you can leave from here and actually apply them to your own life. And if you don't apply them to your own life, then there's nothing else I can do for you, right? I can't make you apply this, okay? But everything I do on the show every single day is about application, okay? I may tell you a bunch of facts. I may tell you a bunch of things that are true, okay? But ultimately, it's to motivate you towards applying it in your own life. It's to motivate you towards action. And I want you to act in a way where you have the knowledge, where you have the education. And the only way you can have it is to go out and get it and go out and attain it. Look, I've put out, this is my 315th episode of this show. That means there's 314 more that you can go back and watch and listen to. It's on the podcast, whatever. You can go back and listen to all of those, and you will learn a lot about your finances, okay? And it can help you in that place. Now, I'm not saying I've covered everything, and I'm not saying that I ever will cover everything, okay? But it will help you in alleviating that ignorance and getting you on the right track financially and help you to make good decisions. That's what I want. Make good financial decisions and be active, be aware, because I think a lot of times when we're ignorant, that just makes us not want to act. I want you to act, and I want you to be the best you can be in your financial life. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual watching or listening to this show on a day-to-day basis. So tune in Monday as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning in to this episode of Money's No Object. I'm your host, Dylan Howell. God bless.